All right, let's dive into Lululemon's latest quarterly results. Now, on the surface, the company looks pretty healthy, but when you start to dig into the numbers, you find a much more complicated and honestly, a more fascinating story. Let's get right into it. And that brings us to the central puzzle of this whole report. Lululemon's revenue is still climbing, hitting a massive $2.5 billion. But here's the thing, their net income, their profit, actually went down. So what's going on here? I mean, how can a company sell more stuff but end up making less money? That is the exact question we're going to answer. So to start, let's look at the headline numbers. And really, they paint a picture of a company with a bit of a split personality right now. Some numbers are pointing up, others are pointing down, and it all adds up to a very mixed report. This table really tells the story. You see total net revenue, it's up a healthy 7% year over year. That's solid growth by any measure. But then you look at diluted earnings per share, which is a key measure of how profitable the company is, and that's down 2%. So it's like the sales engine is humming along just fine, but the profit engine is sputtering. And let's just talk about that $2.5 billion revenue figure. That is a huge number. It proves that demand for Lululemon's products is still incredibly strong. But the real story here isn't how much people are buying, it's where they're buying it. And that question of where leads us right to the star of the show, Lululemon's international business. And I'm not exaggerating here. This isn't just a bright spot. It is the main engine that is driving almost all of the company's growth right now. The difference in performance here is, well, it's staggering. Net revenue in the Americas grew by a really sluggish 1%. Now, compare that to the rest of the world, up 19%, and mainland China, which saw an explosive 25% growth. This isn't just a gap, it's a chasm. Lululemon's international markets are absolutely on fire. So, how are they doing it? Well, if you look at comparable sales, that's just sales in stores that have been open for at least a year. They grew by a combined 15% across all their international regions. In China, that number was an incredible 17%, mostly driven by a big surge in e-commerce and opening 27 new stores in the last year. This is where all the good news is coming from. But, for every action, there's reaction. And while Lululemon's international business is absolutely booming, its home turf, the Americas, is telling a very different and frankly a much more concerning story. And here's that contrast in black and white. While those comparable sales internationally shot up 15%, in the Americas, they actually declined by 4%. That means in their biggest, most mature market, sales in their existing stores are falling. For any retailer, that is a significant red flag. And the company knows it. You don't often see a CEO use language this direct. When Kelvin McDonald says they are disappointed with the U.S. results, that's a crystal clear admission that things are not going according to plan in their biggest market. This isn't just some analyst speculating. This is confirmation straight from the top. So, what's causing this? The company's own analysis points to two main problems. First, fewer people are walking into their stores. And second, the people who do come in are less likely to actually buy something. That combination of lower foot traffic and lower conversion rates is a recipe for declining sales. Now, as if the slowdown in the Americas wasn't enough of a problem, there's a new challenge on the horizon that's about to make things even tougher. And this one directly hits their bottom line, which helps us solve that initial puzzle of why profits are falling. To understand this, we need to talk about something called the de minimis exemption. It sounds a little technical, but in simple terms, this was a rule that let Lululemon ship a lot of its online orders to U.S. customers from, say, warehouses in Canada without paying any U.S. import taxes. It was basically a tax-free loophole for small shipments. Well, that loophole has just been closed. And the financial impact of that is massive. Lululemon estimates that losing this exemption, along with some new U.S. tariffs, is going to reduce their gross profit for the year by an estimated $240 million. That is a direct hit to their bottom line, and it's a major reason why profits are falling even while sales are still climbing. So when you add it all up, you've got a real tale of two companies. One is a fast-growing international powerhouse. The other is a struggling domestic retailer that's now facing significant new costs. And all of this leaves one big question for the future. Can the incredible momentum they have abroad generate enough growth to overcome the very serious headwinds they're facing right here at home?